This is exactly, though, Joe, I feel like what we discussed yesterday. The market's up, noise versus reality, bark versus bite, bluster versus actual policy. People are looking to buy the dips because they still see the larger environment, the one that the president spoke about, as being good for stocks.
Tactical opportunity, certainly for small caps, energy, healthcare, the areas of the market that have been performing so far year to date. We'll dig deeper into this later in the show. Software down once again in a tape that is moving higher. So there are still things to be concerned about. I still don't think we have the all clear as it relates to Treasury yields,
which are down, which are, you know,
1.5 basis points for a 10-year. So 10-year got up to 4.3 yesterday. Was it 4.279? That's not really yields moving lower significantly. So yesterday there was tactical opportunity. You absolutely have to take advantage of a day when you're down greater than 1%. The market has subsequently rallied off of that. I think the areas of the market that you focus on tactically are what has been working. Don't bottom feed.
Okay, so Shan, noise versus reality. That's been really the market that we've lived in for the better part of the last year. Because there's been a lot of noise at times, but the reality was that the S&P clocked a pretty good year in 25. And the point that Joe Kernan made yesterday that I cited on our program, and again, he's going to sit down with President Trump, is that if you focused on the reality and not the noise, you did well. If you bought the noise, you did well, because stocks have been unsettled at times of noise. Are we at another one of those periods?
We think so. I think the reality is, and we talked a little bit about this last week, Scott, that there's a bit of fatigue in terms of policy. And I think that investors, if we had these similar announcements that we've received over the last couple of weeks, we would have had probably a greater drawdown in the S&P 500 this time last year. And again, it's sort of the 48-hour rule. I think if you look at, for instance, the 10% cap on credit cards, now that's being pushed to more of a legislative agenda item. That's going to be much more difficult to get through Congress. So therefore, you could see that as an opportunity to potentially invest against that. You look at the, what happened in Venezuela. Joe talked about we've seen some energy strength. That's outside of any expectations of short-term increases in supply of oil. That's more of a long-term trend in terms of the opportunity from a valuation perspective in energy. You look at technology, to Joe's point, this dispersion, this rotation, this has been in place for some time. And so I think what you need to do, Scott, is you need to take a step back, understand that there may be sectors, industries, specific companies in some cases that are beset in a short-term way by some of these announcements. The implementation, the execution of this type of announcement in 2025 was, quite different in many cases from what was being proposed. And I think most importantly, you go back to economic fundamentals, earnings fundamentals, and where these companies are positioned for 2026. And I think that's where you can come in getting some comfort in buying the names that you think are positioned for that reacceleration.
I feel like, Malcolm, Tony Pasquarello at Goldman Sachs has really had a knack for focusing on the fundamentals above everything else, in which his latest note, I think, goes there. He surveys the environment, not naive to the challenges, obviously, that exists, and says, quote, U.S. equities should be supported by a macro outlook that's inherently favorable, yet risk-reward remains tricky until we see better levels. In the doing, I suspect the tactics of navigation this year will favor the buying of dips, as distinct from the chasing of rips.
Yeah.
What do you think?
I think we're likely to get a lot more of these dips this year, right? We're heading toward a midterm election where we're probably going to see the president get a little more aggressive in making sure that he enacts the last few pieces of his political agenda before potentially Congress gets the balance in Congress gets upset. And so we're probably going to get a lot more of these like existential shocks over the 48-hour cycle like Shannon was talking about, which probably create a number of opportunities for investors who have been looking at specific names, not sectors or the entire market, but specific names that have been beaten down or thrown out with the entire bathwater. It gives you those buying opportunities throughout the entire year. But analyst expectations for earnings growth is 8%. This quarter we're coming into, and then double digits for the rest of this year. That underneath the surface tells me that we should have a pretty strong setup for stocks.